Hi there. So let's look at example 3 on the issue in relation to expenses, and we want to actually look at a very comprehensive example that entails a lot of workings. Then from there you will take a full ICAG question and find out how we can calculate the corporate tax of a company, taking into consideration capital allowance, taking into consideration the issue about capitalization of expenses, and also finding out how we can determine the tax at the end of the year for the company. So that's what we want to cover in this video, and I'm hoping that this is going to be the final video for this topic. So Ponzi PLC commenced business operations on 1st April 2016 and prepares accounts ending 31st December. During the year, the company acquired the following assets: plant and machinery 510,000, motor vehicles 130,000, and that gives us a total of 640,000. During the year ended 31st December 2017, the company incurred 51,000 for replacement of a part. I don't know how I can say this thing. For a part of the engine of for the replacement of engine of the motor vehicle required. Compute the capital allowance for 2016 and 2017 year of assessment. All right. So very important here, we need to look at what is happening. So we're dealing with Ponzi PLC, and we are dealing with a capital allowance, but it is plant and machinery and motor vehicle. Now, plant and machinery and motor vehicle are all what? Class 2 assets. Sounds good? Class 2 assets. So reducing balance method at 30% for the capital allowance calculation. So for 2016 year of assessment, it's going to be from April 2016, right, to 31st December 2016. Now, if you check that closely, that is going to be April, okay? April to December. So this, you realize that a company prepared the account for 31st December every year. So the basis period here is going to be less than what? The year of assessment. So you realize that the assets were acquired on April 1st. So if that is the case, what do we do? So from April to December, we need to calculate the number of days that were in there. So from April to December, if you want to calculate the number of days, I think I had done that somewhere in one of my notes here. Yes, one of my notes here. So we look at April, May, June, July, August, September, October, November, December. How many days are in April? 30. May, 31. June, 30. July, 31. August, 31. September, 31. October, 31. No, September is 30. October, 31. November, 30. December, 31. So when we add all, we will get what? 175 days. So meaning that from 1st April to 31st December, 275 days. Why is this important? It's important because of our calculation of what? The capital allowance, right? Very, very important. For 2016, the cost of the assets is 640. When we add the two together, remember this is a class 2 asset. So we add the plant and machinery and the motor vehicle, it's a class 2 asset. So the capital allowance in this case is going to be the value 640,000 times 30% times 275 days divided by 365 days. Sounds good? Yes, that's how we go about it. And that will give us 144,658. So we're going to less capital allowance. And that will give us the written down value carry forward of 495,342. So that is a capital allowance for 2016 year of assessment. Then let's see what happens in 2017. In 2017, that is going to be 1st January 1, right, 1st January 2017 to 31st December also 2017. So we're going to bring the written down value brought forward, and that is 495,432. Now in 2017, something happened. We were told that during the year ended 31st December 2016, the company incurred 51,000 for replacement of a machine. So this is an additional cost they incur, repair, the improvement. So which portion should be allowed for the income statements for the calculation of the adjusted profit, and which portion should be capitalized? That is our concern here. So to be able to determine how much of the 50,000 should be capitalized and how much should be written off to be deductible, we need to do our workings for it. So let's work that out. So repairs and maintenance. Under repairs and improvements, So for repairs and improvements, it's a class 2 asset. So the written down value brought forward, it's here 495,432. The law states we determine what? 5% of that value, right? But before we determine 5%, it's always the written down value at the end of the year. At the end of the year. So what do? We need to calculate what? The capital allowance for the year. So capital allowance for the year, since it is full, and remember, class 2 assets are on reducing balance. So it's going to be 30%. 30% on this figure, and that is going to be 148,603. So when we less it, written down value carry forward, as at the end of the year, it's going to be what? 345 or 346 739. 346 739. So that is going to be the written down value carry forward. Okay? Written down value carry forward. So if that is the written down value carry forward, what do? We need to now bring our repairs and improvements here. Then we also bring our written down value carry forward here. Then we will look at the 5% of all the written down value. Okay, so let me just put it here straight up. Okay, let me go this way. The 5% of the written down value. So the repair and improvement cost we incurred for the year was 51,000 Ghana cedis. Now, when we get 5% of this written down value, remember, it is always the written down value at the end of the year. At the end of the year. So 5% of that figure is going to give us 17,337. Remember, we said that repair and improvement, how much that is deductible should not be what? More than 5% of the written down value at the end of the year. So, even though we've incurred 75,000, we can only allow 17,337. Meaning, we have to capitalize the difference. So, determination of capitalized amount. Determination of capitalized amount. If we want to determine the capitalized amount, simple. So it's going to be the amount incurred without a doubt, that is 51,000. Then we subtract the amount allowed, okay, the amount allowable or deductible, which is this figure, 17,337. So when we deduct that, then we will get amount to be capitalized. So the amount to be capitalized in this case, the difference of that is going to be 33,663. 33,663. So this is what you need to understand about the determination. So look at the workings right here. We said 5% of the written down value at the end of the year. 5% of the written down value at the end of the year. 5% of the written down value at the end of the year. So we have to pretend to calculate the capital allowance before, because the main schedule will not come, but we have to pretend. This is workings, okay? All of these things we're doing is workings. So we need to first determine how much capital allowance would have been calculated for that year if not for the improvement. Then we get a written down value. Then we get 5% of the written down value. Then we now compare that with how much repairs and improvement that was paid. But we have to allow not more than 5% of the written down value. Boom, the difference will be capitalized. So since the difference will be capitalized, what do we say? In 2017, we will say the addition that will be coming, which is from the workings we did, is 33,663. So that amount will be what? Capitalized. If that amount is capitalized, then the depreciation basis will now become 529,005. So this becomes the depreciation basis. So now we can calculate the capital allowance for 2017. So the capital allowance for 2017, remember, how many percent? 30% of that, that is going to be 158,702. So when we less it, the written down value carry forward, it's going to be 346,000. No, not 346,000. 370,303. So this is how we calculate the capital allowance for 2016 and 2017. Now I want you to make sure you go over this video again and make sure you understand well what we just did. The examiner said we should calculate the capital allowance. We are determining the capital allowance for 2017. But before we determine that, because in 2017 there was improvement, there was repairs and improvement, we need to go and do a workings on how much of the repairs and improvement that can be deductible and that can be capitalized. To do that, we need to find out the written down value of that pool of assets, which is the class 2 assets under consideration, at the end of the year, the written down value at the end of the year. So what do? We need to bring the written down value at the beginning, calculate the capital allowance for that year, and then get the written down value at the end. Then we get 5% of the written down value, then we compare that with the repairs and improvement that has been incurred. If we look at the repairs and improvement that has been incurred, bam, what do? We can now calculate and determine how much should be allowed and how much that cannot be allowed. So that is what you need to understand in relation to that. So this is an exhaustive question in relation to how capital allowance is treated. And not only capital allowance, the issue about the repairs and improvements allowable and not capitalized, right? And capitalized. All right. So this is what you need to understand about capital allowance. So look at the stages we went through, the various pieces of questions we went through, the various ideas that we put together. These are the things that you need to understand under capital allowance, okay? These are the things you need to understand under capital allowance. Now, let's look at a full question now. And this is actually a past question from the ICAG. So I'm going to just tap into that and solve that question. And this is May 2018 CA Pass question on Taxation and Fiscal Policy, May 2018. Okay, so May 2018, we're going to find out how we can solve that question. Okay, how we can solve that question and also help us to understand it. So let's get a question. That is question 2A. Okay, question 2A. That's what we want to look at. The requirement was to calculate the capital allowances for the year 2017, and we calculate the chargeable income for that year. So Sechiwa Anam Industries Limited, Sechiwa Anam Industries Limited manufactures personal hygiene products or personal hygiene soaps and related products at their factory in Takrade. The company commenced business operations on 1st April 2016. Very important. So date of commencement of operation is 1st April 2016 and had assessed loss of 150,200 Ghana cedis and had an assessed loss of 150,200 Ghana cedis for the year ended 31st December 2016. So for the year ended 31st December 2016, the company actually made loss. The company recorded a net profit of 762,800 for the year ended 31st December 2017 after taking into account the following transactions in the income statement. So after they take into account the following transactions, okay? 1. Gross rental income of 180,000 received from the leasing of one wing of the office building. The rental income portion constitutes 10% of the office building. Be careful here. So when it comes to building is a class 4 asset. Now, so out of the total class 4 assets of the organization, 10% of that has been leased. Meaning that when we are calculating capital allowance, we will only calculate capital allowance on 90% value of building. Very, very important. Very, very important. Because when you lease out an asset, you are not using it in your business, and so you cannot claim capital allowance on it. So for the first transaction there, we are going to do what? Subtract that 10% from the value of the building which has been given in the additional information before we calculate our capital allowance. Very important. Second, the net interest received on bank deposits from Ghana Commercial Bank of 10,028. Withholding tax of 8% has been deducted. So the net interest that was received was 10,028, and withholding tax of 8% was deducted. But what we need to do with this one, the adjustment we have to do, is to calculate what? The gross income and add it to the profit of the company. We calculate what? The gross income. Now this is the net income. The 10,028 is the net. But always we are interested in the gross because we are going to charge tax later on in relation to it. So that's how we treat the second aspect of that. The registration of trademark at the total cost of 75,000 in respect of the company's personal hygiene soap that is to last for 10 years. Now, immediately you hear the word trademark, that means there is what? A class 5 asset, intangible asset, right? And this is an acquired intangible asset. But let's see. The research and development expenses incurred in connection with these soap amounted to 15,000. So we registered the thing for 75,000, but we incurred a research cost of 15,000. And the company intends to expense it. The legal cost incurred to complete the registration of the trademark was 5,000. Now remember, we are told that the research and development expenses incurred in connection with that, the company intends to what? Expense it. Meaning, they have already deducted that from the net profit that has been provided to us. However, the trademark registration and the legal fee relating to the trademark, so the 75,000 plus the 5,000, which gives us a total of 80,000, relates to intangible assets class 5 that has to be what? Capitalized. And then we will use the useful life of what? 10 years to calculate the capital allowance. And that is in the year 2017. Very important. Fourth, a donation of 120,000 worth of furniture was made to a local government assistance school as part of the company's corporate social responsibility program, which was duly acknowledged by the Ghana Education Service. Okay, so if it is acknowledged, donation is an allowable expenses as part of our corporate social responsibility as a company. So no big deal, it's a good thing, we go for it. I. Depreciation on fixed assets was 57,000. Now, depreciation, if we are calculating the profit of the company or chargeable income of the company, depreciation has to be added back to the net profit for the year 2017. So we're going to be adding back the depreciation. Next one. Exceptional cost amounting to 150,000 as a result of the production manager sustaining an injury whilst working on one of the production line in the factory. The production manager was rendered incapacitated and resigned as a result of the incident. 35,000 Ghana cedis of the cost relate to a payment made to the production manager as severance pay. 130,000 was used to acquire additional computers. The remaining 5,000 of the cost represents fines imposed by the Factory Inspectorate Department of the government following the incident. Be careful here. So be careful here what is happening. The company incurred a total cost of 150,000 in the production department. Of that 150,000, we paid 35,000 as something we paid to as a severance cost to the. So we paid 35,000 of the cost, which relates to the production manager as severance pay. Now that is a severance pay, so that will be allowable. We don't have problem with that. But then 130,000 was used to acquire additional computers. Meaning class 1 assets, we acquire additional during what? The year. Then also 5,000, the remaining 5,000, so 35,000 was paid as a cost, that one will be allowed. 130,000 was also paid, that one we need to capitalize it for the computer. Then the remaining 5,000 cost represents fines imposed by the Factory Inspectorate Department of the government following the incident. So what do? That 5,000 will be what? Non-allowable deduction, because if you misbehave as a company and you are fined, you are not supposed to write that into your books as expenses allowable. So we are not going to what? Allow that. So that figure, that 5,000 would have to be added back to the profit. Then the last thing is that purchases of computer server for accounting and human resource needs at a cost of 20,000 Ghana cedis. So meaning throughout the year, we will add the 20,000, the computer server, to the computer acquisition 110,000, making 130,000, and add it to the class 1 asset as an addition in the year 2017. So these are the various treatments we're going to be doing. Additional information. Details of company's other assets at cost are provided below. These were all acquired or constructed during the year ended 31st December 2016. So we have factory 80,000, plant and machinery 510,000, office building 420,000, furniture and office equipment 60,000, motor vehicle which is 130,000, and then computers 30,000. So the computer certainly is going to be what? A class 1 asset, and then all of the other assets will be classified respectively. We are required to calculate the capital allowance claimable by Sechima Anam Industries Limited for the year ended 31st December 2017 using all available information, and that was an 8-mark question. And then we were supposed to calculate the chargeable income of Sechiwa Anam Industries Limited for the year ended 31st December 2017. So first, we're going to be calculating the capital allowance. But remember, whilst we are calculating the capital allowance, we're going to be taking into consideration the additions. Whilst we are taking into consideration the addition, remember that we were told that there was a replacement. So replacement of 2 motor vehicle engines costing 51,000. So that 51,000 would also have to be capitalized. So in the next video, I'm going to take time and then solve the question, and then we will see how we treat and calculate the chargeable income for a company, but very importantly also the treatment of capital allowance and the various items that are involved. So I'll see you in the next video, which is going to be the last and the final video for this topic in the entire module.